All right, so the last step in the whole process is to create our financial statements here. We're going to do an income statement, statement of retained earnings, and balance sheet. And what I did is I put the screen grab of the trial balance on my left side here. And then we're just going to take the information from the trial balance and plug them into the financial statement. So when you do an income statement, this is something you got to lock in this semester. And when you take managerial accounting, income statement. What are you looking for in an income statement? Always revenues and expenses. So if you go to your trial balance, look at the very bottom, you see service revenue, salaries, wage expense. Those are things that are going to your income statement. So income statement will always be for the month ended on the third line. And then the top of our income statement is always revenues. So you have the title for revenues, and then we're going to put the actual revenue account here. I got service revenue, which is our only revenue account from our little example, but if you had more, you would put more in. Anything that says revenue that's not deferred revenue, right? It has to be actual earned or delivered revenue, so that goes in here. So that's our only revenue account, so I have the 7,200. Here's a subtotal. Make sure you label that subtotal as my total revenues. Next section on income statement, net income is revenue minus expenses. So next section will be expenses. Look for your expenses in your trial balance. I only have one of them. That's my salaries and wage expense for $1,500. No other expenses. If you did, you would list them down here. I got a subtotal. That 1,500 subtotal is going to be my total expenses. And then all we do all day, all night on an income statement, the bottom line is your net income. Net income is on the bottom line of the income statement. We take our 7,200 in revenues minus my 1,500 in expenses, and I get $5,700, right? So there's your income statement. So let's go to statement of retained earnings. Statement of retained earnings is always going to be for the month end because it's telling a story about the entire month. How do you go from the beginning to the end? So we started at zero. Remember, what are earnings, first of all? Earnings is net income. What does retain mean? Retain means keep. So retained earnings at the beginning of the month are the earnings we kept. Well, if you didn't have any earnings, we just started our company. So there's zero earnings for this company. There's nothing to even have or retain. So we started with zero. For other companies, it'll just be the ending retained earnings of the last month or the last year would be your beginning for this year. So what's our formula for retained earnings? We start with the beginning balance. We started with zero. What do we do this month? We added our net income, and how much net income did we record here? $5,700. You take it right from the income statement. So we're going to go from the income statement over to statement of retained earnings, and we're going to put that $5,700 in. And then the next thing you do on a statement of retained earnings, you subtract your dividends, look at your trial balance, and there's my dividends account, $2,000. You can put that in as a positive or negative. I'm going to put it as a negative. Whoops. I'll put it as a negative $2,000. So then at the end of the month, how much of this $5,700 of earnings, right? Earnings equals net income, did we keep? Well, if we paid $2,000 of that $5,700 to our investors, we took $2,000 of those earnings out of our company, that means we kept $3,700 of it. You go $5,700 minus the $2,000. So there's your retained earnings of $3,700. So now let's go to the balance sheet. Balance sheet, always at January 31st, because you're saying what's in all of these accounts on the last day of the month. Top of the balance sheet. So balance sheets are either going to go left and right or top to bottom. This one's a top to bottom balance sheet. We're going to put our assets on top. And we want to classify the balance sheet. All right, so a classified balance sheet is going to take our assets and classify them into current and non-current. So I want a current assets section at the top of the balance sheet. Then I'm just going to go right down the line. If you look here, my trial balance grouped 5 assets all together. I want to get those all into the balance sheet. Which ones are current? Well, cash is always current. So I'm going to put the cash in there, $39,850. And then, all the other current assets are going to be things that you're going to either turn into cash or use up, generally within 1 year. That's a good enough rule for your purposes right now. There's some more intricacies to that, but for our purposes right now, we're going to say in a year. Are we going to use or cash in these assets within a year? So look at your accounts receivable. Are you going to turn that $2,000 of accounts receivable into cash within 12 months from now? And the answer is hopefully yes. You want to collect from your customers probably within a month if possible. So we'll put accounts receivable as a current asset. Supplies. you're going to use up, think pens and papers, pencils, markers, you're going to use them up now, right, within a year. So supplies are generally current assets. Now prepaid, your prepaid insurance, in this case it is a current asset, but why? If you remember that $600, you got to go back to the transaction. This was something where we paid for 6 months of insurance in advance. So since we're going to use up that insurance within the next year, it's a current asset. But if we paid for 3 years of insurance, you know, 1 year the insurance would be current and the other 2 would be non-current. So you would actually have to split up the prepaid account for that purposes. But in our case here, the prepaid insurance is a current asset. And then equipment generally is not a current asset because you're going to generally hold on to that for more than a year. So that's all our current assets. You have a subtotal here. Make sure you label your subtotal, total current assets. And then we'll go on to the next piece here. Now that I've done the current assets, I'm still in the assets section. I want to list my non-current assets down here. So I'm going to go equipment, right under, whoops, I actually accidentally put accounts payable in there. So right under the total current assets line here, I want to put equipment. And I'll put the amount right for my trial balance, which is $10,000. And that's the end of my assets. So I got all 5 of the assets in the balance sheet. So my current assets are $42,850. My equipment is $10,000. Here I have another subtotal. Make sure you label that as your total assets. So my total assets are $52,850. Right, so there's your assets section. Let's go to the next section of the balance sheet, which is liabilities. So my next header will be liabilities. Let's classify our liabilities. So I'm going to go current liabilities as my first section. And if you look at your trial balance, you have 3 liability accounts: accounts payable, deferred revenue, and notes payable. Accounts payable is always a current liability. We're hoping that we should be paying our accounts payable. We should be paying our bills within a month or so, which is less than a year. Same rule on current liabilities. Are you going to pay or you know, kind of earn up or pay the liability within a year? So if we look at deferred revenue we will call current. And for our purposes, we're going to use those, we're going to actually earn up all that revenue. That was the 1-year contract that our customers bought in advance. We're going to earn all that up within the next 12 months. So that's going to be a current liability. Again, if it was a 3-year contract, you know, some of that would be non-current. And then what's the last one? Notes payable short term. Put that notes payable short term. By definition, it says short term. That's a current liability. And again, we're going with the 12-month rule on that. If the note is 12 months or less, or 1 year or less, it's current and short term. If not, it'll be long term, and it would be not in the current liability section. Right. So those are 3 liabilities, and they all happen to be current liabilities. So I'm going to total out my current liabilities here. And then, you know, I have an area here to enter any liabilities that are not current, but we don't have any. So we're going to leave these 2 lines blank. And then this total here is actually going to be my total liabilities. My total liabilities in this case happens to be the same as my total current liabilities. So there's that. And let's do the next section, stockholders' equity. And all day, all night on the balance sheet, your stockholders' equity accounts are common stock and retained earnings. So anytime you build a balance sheet, those should really be your stockholders' equity accounts for now. Common stock we're going to take right from the trial balance, $20,000. Retained earnings. Here's the trick on this one. You do not take retained earnings from the trial balance. Do not take it. Okay? This is the only account that you don't take from the trial balance when building your financial statements. What do you think retained earnings is? Pause the video and think about it for a second. I'm going to delay. I want you to think about it. Where do you think that comes from? Hopefully, you remember that the retained earnings amount comes from, whoops, I'm in the wrong place. The retained earnings amount comes from requirement B, the statement of retained earnings, right there. Your ending balance of the statement of retained earnings is what goes on the balance sheet in the retained earnings column. So that $3,700 I put in here. And then let's total up everything. The $23,700 is the 2 accounts in stockholders' equity, so that's my total stockholders' equity. Make sure you label that. And then the $52,850 is the $29,150 in liabilities plus the $23,700 in stockholders' equity. So that bottom label is going to be total liabilities in stockholders' equity. And then one last thing you want to do is you want to look at your assets here. that are $52,850, and you want to look at your total liabilities and equity and make sure those match. If those don't match, you know right away that you're wrong. If they do match, you have a pretty good chance that you're right, put it that way. Alright, so that's how you build a balance sheet, and that's the last step in the process. Thanks.